Imagine waking up one morning, checking your credit score, and seeing it jump by 50, maybe even 100 points in just 30 days. Sounds impossible, right? Most Americans believe building credit takes years, but there are completely legal strategies smart borrowers use to improve their FICO scores much faster than people think. And no, this isn't some fake internet hack or risky loophole. These are real methods used by financially smart Americans every day. The truth is, your credit score controls almost everything in the United States. It affects mortgages, car loans, credit card approvals, apartment rentals, and sometimes even job opportunities. The difference between a low score and an excellent one can literally save or cost you tens of thousands of dollars over your lifetime. And the craziest part? Most people damage their score without even realizing it. One of the biggest factors is something called credit utilization. That simply means how much of your available credit you're using. For example, if your credit card limit is $10,000 and your balance is $5,000, you're using 50% of your limit. To lenders, that can signal financial stress. Experts recommend keeping utilization under 10%, ideally between 1% and 5%. Lowering this alone can sometimes boost your score within a month because card companies report balances every billing cycle. Here's the trick most people don't know: banks often report your balance before the payment due date. So even if you pay in full every month, the credit bureaus may still see a high balance. Smart borrowers pay down their cards before the statement closing date instead. That small timing adjustment can instantly improve how your profile looks to Experian, Equifax, and TransUnion. Some people see sudden score jump simply because they learned how the reporting system actually works. Another powerful strategy is becoming an authorized user on someone else's credit card account. Wealthy families have quietly used this for decades. If a financially responsible person with a long credit history adds you to an old low-utilization account, that positive history may appear on your credit report too. Your average account age improves, your utilization may improve, and lenders suddenly view your profile as less risky. But this only works if the primary account holder manages credit responsibly. One of the fastest overlooked methods is checking your credit report for errors. Millions of Americans have mistakes on their reports right now, including duplicate debts, incorrect late payments, or collections that should have already been removed. Under federal law, you have the right to dispute inaccurate information. If lenders cannot verify the debt within the required timeframe, it may be deleted completely. Some people see massive score increases simply by cleaning up reporting errors. You should also avoid unnecessary hard inquiries. Every time you apply for financing, lenders may perform a hard pull on your report. Too many inquiries in a short time can make you look financially desperate. Smart consumers research pre-qualification offers using soft pulls before officially applying. Another myth banks love is the idea that carrying a balance helps your score. It doesn't. Paying interest is usually unnecessary for building strong credit. What matters is responsible usage and consistent on-time payments. Also, avoid closing old accounts because doing so can reduce available credit and shorten account age, both of which may lower your score. There's also a psychological side to the credit system that most Americans never think about. Credit scores are basically trust ratings. Lenders want to see stability, predictability, and low financial risk. That's why suddenly maxing out cards, missing payments, or opening too many accounts quickly can make banks nervous. The system rewards people who appear calm and financially controlled, even if they're not wealthy. Many people believe closing unused credit cards is responsible, but that can actually hurt a score. Closing an old account lowers your total available credit and may reduce your average account age at the same time. Both factors can decrease your score. Sometimes keeping an old account open with a small recurring payment, like a subscription, is smarter than shutting it down completely. Here's something banks rarely advertise openly: once your credit score crosses certain thresholds, your financial life changes dramatically. Moving from a fair score into the good or excellent range can qualify you for lower interest rates, premium rewards cards, better apartment approvals, and cheaper financing options. On a 30-year mortgage, even a slightly lower interest rate can save you over $100,000 throughout the life of the loan. That's why financially smart Americans treat credit optimization almost like an investment strategy. They understand that a strong credit score creates leverage inside a financial system built around borrowing and lending. Good credit doesn't just make banks trust you more. It gives you access to opportunities, flexibility, and long-term financial advantages most people never realize they're missing. The reality is, most people were never taught how credit actually works. Schools spend years teaching formulas students may never use again, yet almost nobody explains how interest compounds, how lenders evaluate risk, or how credit scores shape financial opportunities in America. That lack of financial education costs ordinary people billions of dollars every single year. But once you understand the system, everything changes. You stop making emotional money decisions and start using the rules strategically. Instead of reacting to debt, you learn how to control it. Instead of damaging your score accidentally, you begin optimizing it intentionally. So if you want to improve your credit score over the next 30 days, focus on the fundamentals. Lower your utilization before statement closing dates, check your credit reports for errors, avoid unnecessary hard inquiries, keep old accounts open, and use credit carefully instead of emotionally. These moves may seem simple individually, but together they can completely transform your financial profile. Remember, banks profit when consumers stay uninformed. The more you understand the credit system, the more control you gain over your financial future. The difference between bad credit and excellent credit is rarely luck. It's knowledge, discipline, consistency, and understanding how the game is really played.